Welcome to the Deep Dive. It's December 1st, 2025, and well, the market is still trying to find its footing after that recent pullback.
It really is.
If you look at tech, the ambition around AI, that underlying force, is still absolutely there. But what we're seeing now is a real shift in the signal. It's moving away from just pure excitement. Now the market wants to see concrete execution. And it's getting very, very specific about the price tag.
That tension is everything right now. I mean, we are so firmly in this phase where the big platforms are trying to turn their AI story into, into action.
Into high-priced deals, operational milestones.
Exactly. And they're doing it all while fighting this stubborn macro environment that just refuses to cooperate. The friction is, well, it's palpable. It's what's causing all this choppiness.
So that's our mission today. We're going to unpack the latest from the Money Pulse newsletter. We really want to dig into where conviction still lives, and that means looking at large platform M&A and, maybe more importantly, why the bond market is just stubbornly refusing to play along.
Yeah, to set the stage, let's just do a quick snapshot from the day of the pulse. We saw a bit of a pullback across the board. The S&P 500, the NASDAQ, the Dow, all down, but in an incredibly tight range.
Almost a totally flat tape.
Yeah.
The real action was in the outliers.
Yeah.
I mean, you saw Bitcoin down significantly, almost 3% to around $90,000.
Right. And yet gold, the classic hedge, it actually held steady, ticked up a little bit.
But the underlying flow is what's interesting.
That's the key. The flow tells the story. And what it suggested was a tentative move back into large cap U.S. tech, but also, and this is interesting, into small caps.
So this isn't a broad risk-off signal.
Not at all. It's what we'd call a positioning market.
Right.
People are searching for specific value, for direction, and that takes us right into these high-stakes deals.
Okay, let's jump right in there into the M&A arena because the execution story is just screaming here. The big talk is ServiceNow. They're reportedly in deep talks to acquire Armis for up to, what, $7 billion?
$7 billion. It's a massive step change in how they invest. I mean, if this deal actually closes, it would be the largest acquisition ever. It completely eclipses the $2.85 billion they paid for MoveWorks earlier in the year.
Right. So this isn't just organic growth. This is them going out and buying market share at a really premium price.
And Armis wasn't some desperate seller. They had already disclosed $300 million in annual recurring revenue. They were on a clear path to IPO in 2026.
So ServiceNow is paying a premium, no doubt. The question is this a brilliant strategic move, or is it a sign of maybe a little desperation to keep up?
It's a very, very high-stakes bet on what we'd call the platform plus security layer logic. Think about it. ServiceNow is a workflow company. They automate things deep inside an enterprise.
Okay.
But when you use AI to automate a workflow, you automatically expand the attack surface for hackers. So the theory is the company providing the AI has to own the security layer underneath it.
So they're paying a huge price to make sure their platform stays the trusted system.
Exactly, especially as AI multiplies those security risks. It's a defensive move, but like you said, with a very offensive price tag.
But the integration risk here has to be enormous, right? I mean, even for a company as good as ServiceNow, can they really absorb a $7 billion asset that was about to go public on its own?
That is the number one question the market has to price in immediately. Can they do it? Or does this become an incredibly expensive distraction that the margin for error at $7 billion is just, it's razor thin?
If they stumble on the integration, it hits their valuation multiple.
Yeah.
Instantly.
And it sets a really high bar for the next wave of these kinds of deals.
Okay, so that really sets the tone. Now, speaking of execution versus just narrative, let's pivot to Tesla and the self-driving race. Shares jumped after Elon Musk confirmed that robotaxis are now being tested in Austin without human safety monitors.
And that is exactly the kind of operational step the market has been demanding. It moves the needle on that whole narrative trade that, powers a huge chunk of Tesla's valuation.
It's a tangible milestone toward that Cybercab launch next year.
Absolutely. The market sees it that way.
It gives the believers something real to hold on to.
Yeah.
But we have to put it in context. Waymo is still way ahead commercially, right? In terms of paid rides, operational scale.
Fair question.
So why does this one test in one city move Tesla's stock so much?
Because Tesla's valuation is still so dependent on what the newsletter calls the self-driving probability trade.
Mm.
See, with Waymo, its success is sort of priced into its parent, Alphabet.
Right.
But with Tesla, the stock price has this massive future profitability from full autonomy baked right into it. So every time they take a step like removing a safety driver, it makes that future feel more real, more immediate.
It's a huge psychological win for them.
It is. But here's the high wire act. Every single time they take an operational step forward, they also raise the bar on safety and regulatory scrutiny.
They're always one bad incident away from a complete shutdown.
Exactly. One incident could just evaporate that probability premium overnight. So they have to balance this incredible speed of innovation with just extreme safety discipline. And the market, well, it tends to cheer the speed and kind of discount the risk.
So we have this incredible tech ambition playing out against this really stubborn macro friction. Let's switch gears to the bond market, because this is the force pushing back, and it affects every single person listening.
This is so critical to understand. The core challenge here is that the bond market, well, it won't be fooled by just talk from the Fed.
Meaning, even if the Fed cuts short-term rates next year, long-term rates might not come down much.
That's it. The 10-year Treasury yield may not fall nearly as much as people are hoping.
But conventionally, you'd expect the whole curve to drop when the Fed eases. Why is the long end being so stubborn here? What's holding it up?
Because the 10-year yield, what we call the back end of the curve,
Right.
it's driven by these big structural forces that the Fed just can't control with its short-term policy tools. The newsletter points to three main drivers.
Okay, let's break them down. What's number one?
First up is sticky inflation risk. The anxiety over inflation just hasn't gone away. Core CPI is still expected to hover right around that 3% level.
So if you're an investor locking up money for 10 years,
You demand a higher interest rate to compensate you for that. 3% inflation for 10 years means your money is worth a lot less. The bond yield has to reflect that risk.
okay, structural inflation anxiety. What's the second force?
That would be fiscal supply. I mean, the government's debt is just soaring. They're constantly issuing more and more bonds into the market just to pay the bills,
And more supply pushes prices down.
which pushes yields up. Exactly. This is a political and fiscal problem, not a monetary one, and the market is pricing in the reality that this isn't slowing down.
And the third one, the one that's always a bit mysterious, the term premium. How should we think about that?
Just think of it as the insurance premium you demand for locking your money away for a decade. It's extra compensation for uncertainty.
And right now, there's a lot of uncertainty.
Done. Global conflict, political paralysis at home, record debt, all of that feeds directly into a demand for a higher term premium. Investors want to be paid more for that long-term risk.
So the punchline is, the Fed can ease short-term rates to try and help the current economy. But the 10-year yield is pricing in this long-run mix of sticky inflation, government debt, and just deep uncertainty.
Precisely. And this is why it matters directly to you listening right now. If the 10-year yield stays high, any meaningful loosening of mortgage rates will be very limited.
So that dream of refinancing your mortgage is just, it's not going to happen for millions of people.
Yeah.
The Fed could cut by a full percentage point, and your mortgage rate might only tick down a tiny bit.
Exactly. And beyond that, this dynamic makes credit accidents, defaults, more likely across the economy. As corporate debt comes due, businesses are forced to refinance at these stubbornly high rates. That stresses their balance sheets.
The source also mentioned financial repression. Can you unpack that?
In simple terms, it's when the government tries to keep its own borrowing costs artificially low by essentially forcing institutions like banks and pension funds to buy government debt.
So they create a captive market for their own debt.
They do. But the risk is what's called second-order fragility. If you force a pension fund to hold low-yielding government bonds when inflation is at 3%, they can't meet their promises to retirees down the road.
So it solves the government's problem today.
By creating a huge problem for the financial system tomorrow, it's a very, very tricky trade-off.
Wow. Okay, so we have high-flying AI bumping right up against this structural macro wall. Let's look at where the rubber meets the road this week with earnings and economic data.
The sequencing of the data this week is absolutely critical. First up, we're waiting on the delayed November jobs report.
And the consensus is for a softer number, right? A cool down, maybe unemployment ticking up.
That's the signal that would push the Fed to cut rates. But then, on Thursday, you get the CPI data. Headline inflation might edge up, but the core number is what everyone's watching.
And it's expected to stay sticky, right around that 3% mark.
Yes, and that gap, that's the whole story. If the Fed eases because jobs are weak, but inflation stays firm, the tension between short rates and long rates just explodes.
Which flows directly into what people will pay for stocks.
Directly. That tension hits credit spreads and equity multiples, especially for the mega caps whose valuations depend on cheap money forever.
All right, let's pivot to earnings then. 3 key names to watch. First, Micron on Wednesday.
Micron is the bellwether for the AI data center memory cycle. Simple as that. Management guided to about $12.5 billion in revenue. The market needs to see them hit that, and more importantly, show that demand is accelerating into next year.
Okay, then on Thursday, Accenture. This is the big proxy for enterprise AI adoption.
It's the ultimate test of whether AI ROI is real yet. Is all this corporate spending on AI actually showing up in consulting projects? The street needs to see real, high-margin projects, not just more talk about pilot programs.
Are they actually saving money or just paying consultants to explore?
That's the question.
And finally, Nike, also on Thursday. A consumer story.
Yeah, the market wants proof their turnaround is real, not just a story they're pitching. Revenue is expected to be only slightly higher, so it's not about the top line.
It's about margins, inventory.
Wait, exactly. Can they manage costs in this environment? That's what will move the stock.
This whole setup really ties back to what we saw in the market last week, this idea of a great rotation. Money flowing out of the big AI leaders into cheaper names.
And that's a crucial distinction. It's not a broad risk-off panic. It's not people running to cash. It's a positioning market.
Yeah.
Investors are rotating internally, taking profits from the winners, and looking for value elsewhere.
And the health of the market really depends on what this rotation turns into.
It does. I mean, does this become a healthy broadening of the rally, or is it a warning sign that the momentum in those mega-cap leaders is finally getting tired?
So we've covered the high-cost, high-stakes AI execution story ServiceNow, Tesla, and we've contrasted it with the stubborn drag from the bond market. It's technology accelerating into monetary deceleration.
It's two of the most powerful forces in the economy running head-on into each other.
So here's the final provocative thought to leave you with. The Money Pulse highlighted this awkward combo that the market is really worried about. A weak jobs report, followed by a firm CPI inflation print.
That sequence is a trap. The weak jobs report forces the Fed to cut rates, which should be good for stocks,
But the firm CPI keeps those long-term bond yields stubbornly high. It limits the upside. It tightens credit.
And that dual pressure means those momentum names, the AI leaders, they get punished much faster and much harder if their guidance wobbles even a little bit. The macro cushion just isn't there anymore.
It raises the performance bar for every single earnings report.
Exponentially.
And one last thing for you to think about. That rumored $7 billion price tag for Armis. If ServiceNow pays that, it sets an incredibly aggressive price for the next wave of consolidation.
It becomes the new floor.
Exactly. And if this macro friction keeps the cost of capital high, does the AI race fracture? Do only the giants have the cash to make these deals, leaving smaller players to either wither away or get bought for pennies? That growing gap between the tech haves and have-nots, that's the real story to track.
That's the structural risk.
We've broken down the momentum, we've analyzed the friction, and we've set the table for the week ahead. Thank you for joining us for the deep dive.